Matt. The onset of the Iran conflict upended market dynamics. In the first 2 months of the year, we saw a continuation of last year, and then there was almost a complete reversal, nowhere to hide type environment. My question is, as we move forward, if we get away from the short term, what do you see as the lasting market impacts?
Well, you're 100% right that the early part of the year in the lead up to the war with Iran was a continuation of trends. We saw markets in the US pricing a Goldilocks environment. Business confidence surveys were going up. The forward curve for short term interest rates had been coming down. And on top of that, hyperscalers had announced big capex plans for the year ahead. So the US market was pricing this Goldilocks moment. Similarly, with easy financial conditions in the US, we'd seen the dollar continuing to weaken gradually, and international markets performing actually quite well. And when the war struck, a lot of these things reversed. The uncertainty of the war, after hopes of an initial quick victory, set in. Oil prices went up, and that inverted some of the trading behavior in the lead up to the war because countries like Japan, South Korea, regions like Europe are more sensitive to imported energy prices, natural gas, oil, and those economies were obviously soft. Some of the other more mature, rate-sensitive sectors of the economy had also suffered in the wake of this. Think of consumer discretionary stocks, paint companies, specialty chemicals. Higher oil prices weighed on all of that, and so the market was trading perhaps as you would expect in the lead up to and after the conflict. What happens going forward is going to essentially be um, a function of the nature of a ceasefire that's achieved here, whether it's sustainable, and the nature of the way in which the Strait of Hormuz is open. These are sources of genuine uncertainty, and that's why in our portfolios we retain a positioning that's fairly resilient in the face of a lot of different scenarios.
One of those areas that you use is gold for resilience, but gold has been very volatile, particularly on the downside during this conflict. Can you talk about your views on it relative to how you've been managing that in the portfolios?
You know what's super interesting is how efficiently gold has been pricing the reality. And what do I mean by that? Well, it it took a while for the price of oil to go up when the Iran war was being sort of expected to occur and then actually occurring. Interestingly enough, the integrated oil majors traded up ahead of spot oil prices, but gold traded up ahead of the integrated oil majors. So gold, we had noticed in the lead up to the Iran war, had been very sensitive to news flow around Iran. And then when the war actually happened, gold went down, which surprised many people. In essence, what had happened was gold had priced the risk of this war in advance. It's like the old expression, buy the rumor, sell the fact. And what we actually saw in the 1970s, when we had those two oil shocks in 73 and 79, is in the initial wave of an oil price shock, gold was weak. Why? Because it shifted interest rate expectations in sovereign markets. So all of a sudden, bond market participants were expecting lower chance of an easing. And in fact, at one point, the markets were pricing a rate tightening. And so that was weighing on gold. And then as we've seen the ceasefire announced, the price of gold has resumed an upward movement here as the value of the dollar has gone down. Big picture here, though, Iran's war aside, is that the price of gold over the last couple of years has basically started to reflect its renewed role as a monetary reserve in the central bank monetary mix. The value of gold has moved up meaningfully from where it was a couple of years ago. And I think the questions going forward around gold are going to be what happens to the quality of our money? And that will determine the forward path of gold. Final thing I'll say is that on some of the pockets of strength, we've been a net trimmer of gold so that it didn't become outsized in our portfolios, but we still see a valuable role for it, albeit the risk reward in gold is a little bit more symmetrical today than it was a few years ago.
Thanks for your time, Matt. Look forward to speaking to you next time.
Thanks, Anirudh.